Our first learning objective here, keyword describe, looking at the features of fixed income securities. Okay, let's start with just defining fixed income. And when we use those words, what are we talking about? We're talking about debt. Plain and simple, it's debt, such as loans and bonds. When we talk about loans, we're looking at private agreements. When talking about bonds, looking at publicly traded securities. So private agreements are typically between a borrower and a lender. The borrower can be an individual or a corporation. The lender can be a bank or a particular fund that specializes in private credit. When you get to level 3, one of the streams that you can choose from is private markets. In that stream, you will have a number of readings dedicated towards private credit, so you'll learn more about that there. But the most common loan that you can think of is you go to the bank for a mortgage. You're one individual and the bank grants you a mortgage. It is not a publicly traded mortgage. That's between you and the bank. Same with your car loan. Later on, we'll see that those car loans and those mortgages can in fact become publicly traded, but initially they're a loan, a private agreement between you and the bank. Bonds are publicly traded securities. Here we have many lenders, one borrower. The borrower can be a corporation or the government. And when we say many lenders, if you buy a government bond, you're actually lending money to the government. Well, lots of people buy government bonds. That's what we mean, many lenders. All bonds involve some form of periodic interest payment plus principal. There is one exception called a zero coupon bond. A zero coupon bond, you buy at a discount and it simply matures at par. Well, everything that the difference between what you pay and the par value is interest. So in essence, it does involve a payment of interest and principal, which is the par amount that you get at maturity. Let's look at the structure of a typical bond. Investor lends money on day one. In other words, they buy a bond. And over the life of that bond, they will receive coupon payments. And on the last coupon payment, they'll also get the face value of their bond returned to them. This is a bullet bond structure. There are different types of structures, like partially amortizing and fully amortizing bonds, which you will see as we go through the fixed income section. The coupon rate, the cash flow that the investor receives here is the coupon rate on the bond. Let's say it's a 3% bond multiplied by the face value of the bond. Let's say it's a $1,000 bond. That means each payment is $30. We divide by M. M is periodicity. So if it's semi-annual, that means you get 2 payments a year. You divide by 2. Each payment is $15. You will see more of this in this section as well. Let's look at bond features. First feature we'll look at is the type of issuer, the type of bond you're buying. Are you buying government bond or are you buying a private sector bond? For government bonds, we have bonds at the national level, which are called sovereign bonds. But there are governments at different levels in every country. Local government, that's state and municipality. If you are in a country like mine, like Canada, we don't have states, we have provinces. Supranational. What is this? Think about the IMF and the World Bank. You have a bunch of countries, a bunch of developed countries that get together and they fund the IMF and the World Bank. And the IMF and World Bank does its own thing as well, but sometimes they also issue bonds and quasi-government. These are government agencies. So it is a company that is fully owned by the government, and the company has its own sources of cash flows, and it's there to satisfy some particular objective that the private market may not satisfy. Well, they can issue debt as well. When we get to the private sector, corporations can issue debt, can issue public securities, bonds. We make a distinction between financial and non-financial. So financials are banks, non-financial is any other company. So there is a distinction that is made in the bond market between the debt of financial-based companies versus non-financial. And also SPEs, special purpose entities, they can issue debt as well, typically in the form of asset-backed securities or mortgage-backed securities. And you will see more of this as we go through this section as well. Next, we have maturity. This is a date, just a single date on the calendar. It's the date of the final payment, the final interest payment, plus your principal repayment. When we use the word tenor, We're referring to the time remaining to maturity. So if you bought a 10-year bond 5 years ago, its tenor is now 5 years because it was a 10-year bond. There's a date at which the final principal is paid back to you. We are now 5 years into it. Its tenor is 5 years. The next two bullet points, pay attention to these two words, at issuance. So if a fixed income security has less than 1 year to maturity at issuance, we call it a money market security. Greater than 1 year to maturity at issuance, it's called a capital market security. So imagine a 2-year bond with 6 months left to maturity. That is not a money market security because it was a 2-year bond at issuance. It's not a matter of what it is today or how much time to maturity it is today. It's what was it originally issued at? So if it is more than a year when it was originally issued, it is always a capital market security, even though it may only have 3 months to maturity, and it may feel like a money market security because it matures in 3 months. It's still a capital market security. You also have perpetual bonds that have no stated maturity. It's just a bond that's issued that never matures, and it simply just pays a stream of income every year. Next, we have the word principal. The feature of a bond has a certain face value, a par value, a bunch of different names for the same thing. That is the amount that is to be repaid at maturity. This is for a bullet bond. You can have something called amortizing bonds, whether they're fully amortizing or partially amortizing. What that means is every time you get a payment, it's not just the coupon. There is some part of the principal that's repaid to you over time. Mortgage-backed securities are very common for this, that if you buy a mortgage-backed security, which is a bond, every payment you get is a combination of principal plus interest. To the point when you get your last payment, that's it, you're done. The principal declines over time. So some principal is repaid each payment. So I give you an example here, the mortgage you have at a bank, a mortgage-backed security if you buy that in the market. Coupon rate and frequency. You can have fixed or floating rate bonds. A fixed rate bond has a constant amount that you receive on every payment, and that payment may be made monthly, quarterly, semi-annually, or annually. A floating rate bond has a variable coupon, and it's variable with some MRR. That means a market reference rate. There is some rate in the market that we can reference that says whatever the rate is on this date, that will be the coupon. And then maybe 6 months later, it'd say, okay, well, what is the rate now? Now that's the coupon. So it'll have some market reference rate. If it's a government bond, that's the end of it. This is referred to also a floating rate loan as a floating rate bond is a floating rate note, an FRN. Corporate bond will have a spread on top of the market reference rate. So you can have a floating rate corporate bond. The spread would be fixed, but the rate would float. So let's say the spread was 100 basis points. And we observed the market reference rate over 2 different 6-month periods. It was 3% here, and it was 2.5% here. That means the coupon would be 4% here, and it would be 3.5% here. It would be the market reference rate plus the spread, and that would set your coupon. The spread is constant over the life of the bond. Now, that does not mean the credit quality of the bond is constant. It means the spread is constant. Let's say the market thought, you know what, 100 basis points, not good enough. We need 120 basis points considering the risk. Well, this would still remain as 100 basis points. The spread would still say 100 over the market reference rate, but to get the other 20 basis points, the price of the bond would have to drop such that the increase you get from what you pay to what it matures at offers you the other 20 basis points of return. So if the credit quality deteriorates while you're holding it, the coupon, the spread part of the coupon will not change. The price will change to reflect lower quality. And this spread is issuer specific. Some bonds do not have a coupon rate and frequency. Some are just called zero coupon bonds. In other words, their coupon rate is 0%. So they issue a bond with 0% coupon. You simply buy the bond at a discount. It matures at par. So let's say you're holding it over a certain period of time. You'll buy it on day 0. It'll mature at time t, and the return that it generates will be equal to some rate of return, some yield that you would get. And that yield would be all a function of it maturing at par, the difference between the discount price and par, but it pays no coupon in between. Money market securities are basically pure discount bonds. So a 3-month T-bill, you'll buy it at a discount, it matures at par. Same with a 1-year bond, you buy it at a discount, it matures at par. There are no coupons associated with it. Seniority, this deals with the position in the capital structure. When we talk about seniority, you're talking about corporate bonds. It basically states what the priority of claim on assets is, and in order, the highest is senior secured. When it's secured, it means it has specific assets backing up the bond. Then you have senior unsecured, which are just general obligation bonds of the corporation, backed by the ability of the corporation to generate cash flows to pay the bond. And there may be a number of unsecured bonds that are issued. So a company might have 15 different types of senior unsecured bonds that are issued. As far as the law is concerned, they all rank equally. That's called pari passu. We'll see this word a little later on. All senior unsecured rank equally. And then below that you have junior debt or subordinated debt. Some bonds have contingency provisions. Usually lower quality bonds will have contingency provisions. It's a clause that allows for an action if an event or a circumstance happens, typically related to an interest rate or to the price of equity. Most common types of contingency provisions are calls, puts, and convertibility. So callable bonds, puttable bonds, and convertible bonds. Bonds that are convertible to the company's equity. Different types of yield measures. You can calculate a very simple one called a current yield, which is just your annual coupon over the price. So let's say a bond has an annual coupon of 3% and it is selling at par. Let's say if it's 3%, let's say the par is 1,000. That means 3% would be $30, right? There's your 3%. So your yield, your current yield, is equal to your coupon rate if it is selling at par. Here are some relationships. Different types of bonds, premium bonds, or I wouldn't say different types, ways we can describe bonds as premium bonds, as discount bonds, or as par bonds. A premium bond means the price is greater than par. So you can say, well, at maturity, I'm going to get $1,000 back on this bond, but today I got to buy it for $1,020. Why would you ever buy a bond for more than you would get back? It's because the market yield that is required is less than the coupon it pays. Maybe it was issued when interest rates were really high and it was issued with a very high coupon, but interest rates have dropped. But it has this really big fat coupon, more than what you can get anywhere else. And you'd say, well, that's great. Well, everyone else will think it's great and it'll push the price of the bond higher than par so that it yields equally with other bonds at that point. So that's called a premium bond. A discount bond is the other way around. The price is below par. That means the yield that you get is greater than the coupon. So this is just saying that the coupon is not high enough to hit the yield that the market needs to see on this particular bond. So we're going to have to buy it at a discount. And par bonds, price equals par, yield equals coupon. Okay, next yield measure, yield to maturity. This is the one that you're going to have to get used to. This is the one that's referenced most often. It's the bond's internal rate of return. And what do we know about an internal rate of return? It is money weighted, not time weighted. And I will come back to this term when we talk about condition 3 down here. So you buy a bond and you hold a bond and you measure your rate of return. Your rate of return should equal the bond's yield to maturity if 3 conditions are met. The first one is the bond doesn't default. Well, I don't think I need to explain that anymore, right? Number 2, it is held to maturity. So let's think about a 10-year bond. That you buy a bond and it is a 10-year bond, and after 5 years you sell it. As we will see later in this fixed income section when we get to pricing out bonds, that if interest rates change, the price of your bond would have changed. It could either become a premium bond or a discount bond, which means you may have a capital gain or a capital loss. which will affect your rate of return. So your rate of return will not necessarily equal the bond's yield to maturity when you first buy it. Number 3 causes the most grief. Coupons are reinvested at the yield to maturity rate, so that there is no default. You're going to hold the bond to maturity. Your rate of return will equal the yield to maturity on the bond if you can reinvest the coupons at the yield to maturity rate. And look what I write in brackets here: if the cash flows are reinvested. If the cash flows are not reinvested, your rate of return will equal the yield to maturity exactly, because yield to maturity is the IRR, which is a money-weighted rate of return. So let me see if I can give you an example. You buy a bond for $1,000. It's got a 3% coupon. Every year you get $30. If you just take that $30 and you spend it, you still have $1,000 invested. It's going to continue to provide $30 per year. You haven't changed the amount of money that you have invested, so the rate of return that you experience on the money in your portfolio will equal the yield to maturity. The issue comes with reinvested coupons, which is typical of most bond portfolios, is when you buy bonds in your portfolio, even your retirement portfolio, you're not taking that money out until you actually retire. So the money gets reinvested. So think about a bond portfolio at time 0 and a bond portfolio at time t, and your payments are going into your bond portfolio and being reinvested. So if we take our ending value over beginning value minus 1, it will equal the yield to maturity if condition number 3 is true. You can reinvest those coupons at the yield to maturity rate. Okay, let's move on here. Yield curves. This is another term you're going to hear a lot about. They represent yields on all bonds with the same features by the same issuer. The most common yield curve that you will come across is the government par curve. So it represents yields on, we have a 30-day, there's a 2-month, a 3-month, a 4-month, 6-month, 1-year, 2-year, 3-year, 5, 7, 10, and 30-year. These are called key rates. And we look at the yields on all of those, and we plot them against, this is yield over here, and we'll draw out a yield curve. Yield curves are typically upward sloping because the longer you lend money for, there are 2 issues. Number 1, you need a maturity premium. So you're going to have a higher yield the longer you lend money. Not only that, these yields are in nominal terms, right? And nominal yields are made up of a real yield plus some kind of expected inflation. Well, the longer out you go, the more uncertainty there is around expected inflation, so you're going to need a premium for the uncertainty of your estimate of expected inflation. If we have a corporate bond, it will have a yield curve. If we take an issuer, let's take GE, and let's take all of their senior unsecured bonds. Remember now, they have to have the same features, right? Take all of their senior unsecured bonds that they've issued over the years. Some may have 2 years left to maturity, some have 5 years, some have 7, some have 9, and we plot them out. We'll get an upward sloping, typically an upward sloping yield curve as well. And it will sit above the government par curve, meaning, let's just say for this period of time, we can do this, and we would say, aha, the corporate bond would require a higher yield than the government bond. The difference between the two is a credit spread. And here, because we're just using a government par curve and a corporate curve, the difference between 2 points, let's say this was the 6-year corporate bond, we would find a 6-year government bond, and we would measure the spread. That is a G spread, G for government. You'll see more of this later. This is one measure of credit risk. Next learning objective, describe the contents of a bond indenture and contrast affirmative and negative covenants. All right, let's define what a bond indenture is. It's a big fancy word for the legal contract of the bond. It's the contract between the issuer and the investors, and it contains the form of the bond. When we say the form, 10-year, fixed coupon, that sort of thing. The obligations of the issuer, the rights of the bondholders, and the big one here, sources of repayment, so you can assess the credit quality of the bond. For sovereign government, it's quite straightforward. Sources of repayment are usually through taxation or, at worst, printing of the currency. For local and regional governments, they do have taxation. They can't print currencies, but at the local and regional level, a lot of the bonds are issued for specific projects, so there are project cash flows. And then you have corporate bonds. For unsecured bonds, it's typically the operating cash flows for both interest and principal. If they are secured bonds, then you would have a look at the specific assets that are backing up the security. So if you are doing credit analysis, and we are going to look at credit analysis later on in this section, we can see with corporate bonds, our job is to evaluate the operating cash flows plus evaluate the value of the collateral. There's another group of bonds called asset-backed securities or mortgage-backed securities, and these are issued by special purpose entities, SPEs, or you might have heard them called special purpose vehicles. They're interchangeable. So there are certain assets that are backing, that's why they're called asset-backed or mortgage-backed. There are certain assets that back the securities, either loans or mortgages, and these will produce cash flows. Those cash flows become the source for interest and principal payments on the bonds. I'll show you quickly how this works. There is a company that's set up called a special purpose entity, and there's a bank over here that has a bunch of mortgages on its balance sheet. It'll sell the mortgages to the SPE. The SPE will then issue bonds. And there's investors that will buy the bonds, and then the SPE transfers the money back to the bank. And these now become the property of the SPE. So as the mortgages make their principal and interest payments, it falls into the SPE. The SPE pays the interest on the bonds and the principal, and will issue bonds in tranches. Let's correct something on the fly right now. Look at that. I forgot the E. Some of you out there were probably losing it, saying the guy forgot the E. Well, it's back. Calm down. Tranche A all the way to C, senior to junior. There is a whole module coming up on asset-backed and mortgage-backed securities, so it's enough just to introduce it here. There are two broad types of covenants in the bond indenture, affirmative and negative covenants. Typically with investment-grade debt, you typically just have affirmative covenants. High yield has affirmative, but also will have restrictive covenants as well. So let's have a look at what affirmative is. This typically means what the company is going to do, and what it's going to do is typically what it does anyways. And affirmative clauses typically impose no cost or restriction on operating the business. It states what the issuer is required to do is typically administrative. Things like, hey, listen, every quarter you got to file your statements with the SEC. The company would say, yeah, we do that anyways. Well, let's just put it in the contract to make sure that we all agree that you're going to keep doing the things you do, right? There's usually a pari passu clause, which means all of the bonds at a particular level, like senior unsecured, the company may have multiple issues at senior unsecured. In case of a default, they all rank equally. It means on equal footing. A cross-default clause, meaning a default on one is a default on all. So maybe you're holding one of the bonds, senior unsecured bonds, and the company defaulted on an interest payment on another senior unsecured bond. Well, this is the cross-default clause. You don't have to wait around to figure out if they're going to make your interest payment. You say, aha, you missed on one, you're probably going to miss on me. A default on one is a default on all. Negative clauses. This is usually when you don't have great credit. The market will still lend you money, but we'll say, look, you know, we're going to put some restrictions on you just to be safe. This is about what the issuer will not do. So we can see that it will impose some costs and restrictions on operating the business. Limitations on liens, like pledged assets. So maybe you have a secured bond, you're a high yield issuer, you have a secured bond, and maybe in that bond it says you will not pledge any other asset for any other debt that you get. Limitations on sales and leaseback. So we can think of a company, it has assets and it has liabilities. It may sell some of its assets and lease them back. Well, now the collateral is gone, right? So you can't sell the collateral. Restrictions on the issuance of debt that is more senior than the debt you've issued. That's called a negative pledge clause. Restrictions on share buybacks, dividends, or dividend increases, unless certain ratios are met. This is called an incurrence test. And limitations on additional debt. Notice it's different from the one up here. This is restrictions on debt more senior. So this clause will allow the issuance of debt more junior. This clause here says, hey, listen, we'll lend you money, but you can't go out and borrow any more money.